Welcome back to InvestorHubX.com. In this lesson, we'll explore bullish and bearish candlestick patterns. We will break these patterns down into double candle bullish patterns and double candle bearish patterns. These candles do not predict the market. They describe rejection, momentum, and control within the two-candle structure. Let's get started. Let's start with the first double candle bullish pattern, the bullish kicker. The bullish kicker represents a sudden and aggressive shift in control from sellers to buyers. It is made up of two candles. The first candle is a strong bearish candle, showing clear selling pressure. The second candle opens above the previous candle's open and closes strongly bullish, with no overlap between the two bodies. This sharp gap between the two candles tells us something important. Sellers were in control, but they lost control immediately. Buyers stepped in decisively, with strength and conviction. The second double candle bullish pattern is the bullish engulfing pattern. The bullish engulfing pattern shows a clear shift in control from sellers to buyers. It is made up of two candles. The first candle is a bearish candle, showing selling pressure. The second candle is a strong, bullish candle that completely engulfs the body of the previous bearish candle. The bullish engulfing pattern does not predict the market. It shows sellers lost control, buyers absorbed the selling pressure, and momentum shifted to the upside. The bullish engulfing pattern is most effective when it appears at a key support level after a pullback in an uptrend or near the end of a down move. When it forms in the middle of nowhere, it carries much less meaning. This is the pound on the weekly time frame. Price moved down, reversed, and then came back down again, creating a key support level. Notice the bullish engulfing candle here. The body of the previous candle is completely engulfed by the next candle. This forms a double bottom structure, signaling a shift in control and a trend change from a downtrend to an uptrend. Moving on. Let's look at the piercing line, another double candle bullish pattern. The piercing line represents a partial shift in controls from sellers to buyers. It is made up of two candles. The first candle is a strong bearish candle, showing selling pressure. The second candle opens below the low of the previous candle and then closes above the midpoint of that bearish candle. However, unlike a bullish engulfing pattern, the second candle does not fully engulf the first. This shows rejection of lower prices, improving bullish momentum, an early shift in control toward buyers. The piercing line works best when it appears near a key support level. Without context, it is simply two candles. This is intuitive surgical on the weekly time frame. Price is in a clear downtrend. Notice how previous resistance has now turned into new support. At this level, we see a piercing line candlestick pattern. The first candle is a strong bearish candle, continuing the downtrend. The second candle opens below the low of the first candle, showing early selling pressure. However, buyers step in aggressively. The candle closes above the midpoint of the previous bearish candle, signaling a shift in momentum. This tells us that bullish strength is improving. Immediately after that, we see a hammer candle, which acts as confirmation of a potential trend reversal. With structure changing and bullish momentum increasing, the market transitions from a downtrend into an uptrend. Next, the Tweezer bottom candle pattern. The Tweezer bottom is a double candle bullish reversal pattern. It usually forms after a downtrend, near a key support level. The first candle is bearish, continuing downside pressure. The second candle is bullish. What makes this pattern unique is that both candles share nearly the same low. This tells us something important. Price tried to move lower twice, and both attempts were rejected at the same level. Sellers pushed price down, but buyers stepped in each time to defend that area. This creates a clear message. Selling pressure is weakening. Tweezer bottom often marks the end of a downtrend and the beginning of a potential uptrend. Next, we are going to talk about double candle bearish patterns. The first double candle bearish pattern is the bearish kicker. The bearish kicker is a powerful double candle bearish reversal pattern. It usually appears after an uptrend or near a key resistance level. The first candle is a strong bullish candle showing clear buying pressure. The second candle opens with a gap down, opening below the open of the first candle. This sudden gap tells us something important. Market sentiment has shifted abruptly. Sellers have taken immediate control. Unlike many reversal patterns, the bearish kicker does not rely on wicks or indecision. It reflects aggressive conviction, not hesitation. When the bearish kicker appears after a strong rally or at resistance, it often signals the start of a sharp move to the downside. The trend shifts from bullish to bearish, not gradually, but instantly. The second double candle bearish pattern is the bearish engulfing candle. It usually appears after an uptrend or at a key resistance level. The first candle is bullish, showing buyers are still in control, but the second candle is bearish, and it's the key. Notice how the bearish candle's real body completely engulfs the previous bullish candle's body. That tells us something important. Buyers pushed price up, but sellers stepped in with stronger conviction and overpowered that move. This shift shows bullish momentum is weakening. The bearish engulfing pattern is most reliable when it forms after an extended rally at resistance. Here we're looking at the Hang Seng Index on the weekly time frame. Price experiences an extended rally and runs into a key resistance level. At that area, we see a bearish engulfing candle. Price reverses from an uptrend into a downtrend. Another extended rally pushes price back into resistance. Once again, a bearish engulfing candle forms. And once again, we see a clear reversal. Moving on. Next is the dark cloud cover pattern. The dark cloud cover is a double candle bearish reversal pattern. It usually forms after an uptrend or near a key resistance level. The first candle is a strong bullish candle, showing buyers are firmly in control. The second candle opens above the high of the first candle, which initially suggests continued bullish momentum. However, the story quickly changes. Sellers step in aggressively, and the second candle closes deep into the body of the previous bullish candle, typically below the midpoint. This tells us something important. Buyers tried to push price higher, but sellers rejected those higher prices and forced price back down. The pattern signals bullish momentum is weakening. The dark cloud cover is most effective when it appears after an extended rally at resistance. Next, we're going to talk about the Tweezer top. The Tweezer top is a double candle bearish reversal pattern. It usually forms after an uptrend, often at a key resistance level. The pattern is made up of two consecutive candles that share nearly the same high. This is the key idea. Price attempts to push higher twice, but both attempts are rejected at the same level. The first candle shows bullish strength. The second candle shows that buyers can no longer push price higher. This tells us buying pressure is weakening. When the Tweezer top appears after an extended rally at resistance, it often marks the end of an uptrend and the start of a potential downtrend. To summarize, double candle patterns show us how market control shifts between buyers and sellers. Bullish candles show selling pressure weakening. Bearish candles warn buying momentum is fading. They don't predict price, they reveal rejection and indecision. always read them in context, near key levels. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.